Hello, everyone. This is Matt with PriceFX, and we have Lydia here today. We're just going to give everybody just a few minutes to trickle in, and then we'll begin shortly. Great. Seeing a lot of people trickle in, so just another minute or two, and then we'll begin here shortly. Feel free to drop any questions or comments in the box, and we'll be able to address those as you submit them. Thank you. All right, we're going to get things started here. So hello, everyone, and thanks for joining today's live webinar. COVID happened. What's next is up to you. I'm Matt, Partner Marketing Specialist at PriceFX, the industry's leading cloud-native price optimization and management solution. Today's presentation will be delivered by our valued partner, Lydia DiLiello, CEO and founder of Capital Pricing Consultants, a revenue management and business consultancy dedicated to improving profitability for its clients through strategic, operational, and tactical recommendation. She brings more than 25 years of global revenue management, pricing expertise, and business leadership to her clients. Lydia will share how financial data is a powerful tool, and when it's coupled with intentional targeted pricing, business opportunities flourish and revenue increases. Attendees, please feel free to share any questions or comments in the chat or question box to the right. We'll address those questions as they are asked throughout the presentation, as well as to have a Q&A at the end. One last note I want all the presenters to know is that the deck is available for download in the handout section on the right panel. Feel free to download that for future reference, as well as to connect with Lydia. Now let's kick things off. I'm going to ask a few poll questions just to gauge our audience today based on their pricing experience, and then we'll pass it over to Lydia to begin. So for the first question, how many years do you have in the pricing field? 1 to 3 years, 4 to 6 years, 7 years, or plus? Please feel free to answer that. I'll give everyone about 20 to 30 seconds to give their responses, and then we'll share that result. This will be super helpful for Lydia throughout the presentation, just to gauge, how many years you have in the field. Seeing some good results trickle in. So I was just asked if this webinar will be available after for people that have to drop off. If you registered, you will receive this recording in an email once the webinar has concluded. So if you have to drop off, we completely understand. This will be available via email shortly. So I'm going to end this poll right here. Let's share those results. So Lydia, 44% are in the 1 to 3 year space. 25% of our attendees have 4 to 6 years in pricing experience, and 31% 7 years or plus. That's great to see. Looks like we have some really knowledgeable people in the pricing space. And then just one more question, everybody. Are you an analyst, a manager, or other? Please feel free to submit those responses now. And as soon as we have that, we can kick it over to Lydia. So thank you to everyone who's submitting their responses. Give everybody a few more seconds. Looking like manager, we have a lot of managers in here today. Just a few more seconds. I see the numbers still climbing. All right, I'm going to close that poll out right now, share those results. So 20% of our attendees are analysts, 50% are managers, and 30% are other. Feel free to drop what those others are in the comment box, just so we know. And with that, I'd like to pass it over to Lydia to kick things off.
Well, good morning, everybody, and thank you all very much for joining today. And hopefully you can all see my screen. Matt, can you confirm that the screenshot's coming through okay?
Absolutely. And if anyone has any issues or not seeing that, please feel free to drop it in the comment box so I can help out. But I see it.
Great, thank you. Well, this morning, as Matt said, what we're going to talk about is we have all been hit hard from a business and a personal perspective from COVID. So what we do about it going forward is really what matters. Can't change what happened in the past, but we can certainly impact what happens business and professionally and personally with what our choices are now in the future. So I'm going to just, we're going to do this kind of informally because I'd like to have it as interactive as we can, even though I know we're virtual. I'm going to use some anecdotes and some stories and try to do my best to answer all of your questions. Any questions that we don't get to, know that I will follow up with you individually, so don't hesitate to submit something if we don't cover it all. So really briefly, just to give you a background, I've been in the pricing space more than 25 years. I spent half of my career in executive management. So definitely have been through the pains that you all are dealing with in terms of the day-to-day drama and excitement that is pricing. I started my career actually with General Motors on working second shift, so afternoon turn, out on the line, actually building wiring harnesses for, at that time, it was Buick. Seems like a really strange way to start your pricing career, and it was. But I had an opportunity to join General Motors, and that was basically the only way you could get in. So I did that for 9 months, and what I learned from that experience, I utilize today in pricing in terms of how shop floors run and how that can impact cost. And then from that perspective, what does that mean to my margins whenever I'm looking at price? So a strange entrance in, but I have loved pricing ever since. My initial position with GM was then from the shop floor in competitive intelligence. So, and then I also spent 1 year in professional procurement for General Motors. So I've seen a lot of different sides of the table, if you will. So to kick things off, we're going to talk about why do we care about metrics? An awful lot is said about them, and many of you, I am sure, have struggled with them as I did. So we're going to get to which ones really matter, what can you trust, what's a good metric look like, and what's a bad metric look like, how do we want to use them, and how can this help my business run more effectively, and how can I drive new business with these metrics? So today we're going to cover the rule of top customers, top products. What's high volume? Does high volume always mean that that's necessarily the best thing to measure? And we're going to talk about information as a combination, total information that can drive additional business for you. The second area that we'll focus on is margins and what can they tell us? Margins are an excellent business health check for your business. And whether we're talking gross margin or we're talking contribution margin, both of them have ideal opportunities to inform us about what's going on in our business. They're early warning systems when we track them rigorously and continuously. So we'll explore those further. And then finally, we're going to end with a return on sales. What is it? How can we utilize it best? What would be optimal return on sales numbers that we would be looking for? All right. So Matt, do you have another poll question for us?
Absolutely. Just launching that right now. So attendees, do you feel you are using your analytical capabilities fully? Yes, we use our analytics capability fully. Not really sure, or no, we're not using our analytics capabilities fully. Feel free to submit your responses now, please. And this is all anonymous, so Feel free to answer truthfully. I'll give it about 5 more seconds before I close this poll. Looks like we're still getting some votes. I'll give it just a few more seconds. All right. I'm still seeing some answers. I'm going to close it now. Thank you for those who shared. Let's share those results. So 14% said, yes, we use our analytics capabilities fully. 24% not really sure. And 62% said, no, we're not using our analytics capabilities fully. So thanks for being truthful. And with Lydia's presentation, hopefully we can turn that 62% around.
Well, thanks everybody for sharing that information, because I think that that is an extremely common challenge for every business that I have ever worked for, as well as every client that I have ever partnered with now, in terms of what information is being used and why and how and under what timelines. And I think all of us have cabinets full of data that someone requested that we run that took us a lot of time, effort, and energy, and then essentially ended up in the trash can. But we all knew not to throw it out, because the person that asked initially for that information is going to come back 6 months from now and decide that it's critically important again, though we never saw it come to fruition or be acted upon. So I appreciate your answers to the polls. It helps me kind of guide how I'll make comments in hopes that it will be useful for you all. So a word here, as we're talking about metrics, and you say, well, okay, this issue about emotion and decision making. I think the fact is that as a result of COVID, we have never, as people, been more emotional in our lives. We have never been more uncertain of what tomorrow holds, or the things that we have come to expect. And that holds very true for business as well. So the things that we always expected in business, like we were going into the office every day and going to the wherever the coffee machine was or the coffee pot to get that cup of coffee, all of a sudden, all of that changed. And when we progress through decision making, it is not uncommon to transfer that same emotion into how we make decisions, which means that also transfers into how we look at our metrics. So in other words, a metric we looked at before COVID, let's say it was a gross margin of 15%, and our business usually ran at 18%. We might interpret as being not really good business, but we weren't highly concerned to see 15 rather than 18%. Emotion, however, never allows us to make clear, concise decisions. And so now, because we're already on what I'll call hyper alert relative to life in general, that 15% becomes perceived totally differently and can be blown out of proportion or just interpreted differently. So I want to share with you, be aware that your own decision making right now is very likely to be different than what it was 4 months ago. That's normal. It's happening for everyone. So just being aware of it is half the battle. You know, COVID, of course, was a great equalizer for everybody, and that includes our customers, and it includes the buyers that we work with in procurement. So, and the reason I'm bringing this up is the idea of using metrics to get more business means you're looking at those metrics to make pricing decisions or volume decisions or contract decisions. And so you're working with a person, another human who has also been affected by COVID. And what used to be important to them before may not be now. Now I find buyers and customers are looking for partners. They're looking to you to say, give me creative options. Help me figure out how to solve this problem I have. And the problem that I have might be I can't get supply, or you have a part I need, but your price point isn't something I can manage for the next 2 months. So keep in mind as we go through these metrics that one of your best values, one of your key differentiators in how you interpret your metrics is how human you are with the people you are working with your customers and with those buyers. I don't see customers and buyers trying to leverage the kind of negotiation games that they did in the past. So keep that in mind as well. as we're kind of building a base and a level set to view these metrics going forward. And speaking of bases, we also want to look at things that haven't changed. So what hasn't changed for us as we begin to view metrics? Well, our customer base didn't change while COVID happened. Our product base didn't change. And the technology that we were working from, whether we had pricing software systems in place, whether we were using old antiquated systems, which I'm guessing many of us are, those things have all stayed the same. And my point here is, let's work from what we do know, because so often right now, I think it's common to feel like there's a lot of things we don't know, but our base is strong. We know who the customers are, we know what products we can sell, and we know what technology we're working from, whether we like that technology or not, right? And I think that one of the outcomes of COVID in general, as I talk to clients, is they are looking for help because they want to learn more about what's already in their systems. So if you think about metrics, very much like a flight panel, I want to know what every one of those dials means and how it can help me optimize my business. I don't know about you guys, but I don't want to be on a plane with any pilot who doesn't know what every single one of these controls mean and how to use it, right? So each one has its place. Each one is meant for something specific. And so the goal today is to share with you some options and what you can begin to choose relative to what works best for your business. Since 64% of us said that we're not really using the metrics that we've got, or we are, whether we have them or we don't, this will give you an opportunity to look at which ones would be simple to run as well as very useful to leverage. Okay. So in leveraging what we know, we're going to leverage customers and products. We're going to look at key industries as well. Industry, customer group type, volume are all simple segmentation approaches. And that's critical in your metrics. You've got to know what that base of data is that you're looking at. Otherwise, it's not useful. If you can't define very specifically what you're looking at in the report that's been run, it can create confusion and it can actually create communication challenges with executive management. I think most of us have been in situations where we've been asked to run a report, we share it, and it creates 15 other questions that we never anticipated. And twofold reason for that. The first is, I think oftentimes executive management, when they pull or ask for reports, have set expectations about what they're going to see. And when that's challenged, it gives them a whole list of other questions. And then the second thing is, I think because we know what we're looking at when we run a report as practitioners, we don't often define it as precisely as we can to the people that are going to view that report. And we'll talk about that a little more as we move through the presentation. So the things that metrics give you when you run them on a consistent basis is they give you visibility. It's an early warning system. What's going on with my customers? What's going on with my products? What's going on with my margins? It gives you flexibility, because if you see something in one of those reports that you think, this doesn't look right, why did my margin go down this month? You can dig further into it. It gives you discipline, because if you're running that report, let's say on a specific time frame, maybe it's every 2 weeks or every month, you know that you always have history and you also have the opportunity to pull future as well when you hit that timeline. So critically important for continuity of what that picture looks like. And then last, you have accountability. If any of you are in a position where you are trying to encourage your sales force not to discount so deeply, if you are trying to share with them information about what it's doing to your margins, this gives you the opportunity through reports to do that. Matt, did you want to take that next poll question?
Absolutely. launching that right now. Do you feel you run too many analytics and don't utilize output? So attendees, feel free to answer now. Yes, too many analytics and don't utilize output. Not really sure, we don't run many reports, or no, we have a sound process in place. I'll give everybody about 10 to 15 more seconds. Getting some really good response. I see them still trickling in. I'll give everybody a few more seconds. Look like it's a little on the top heavy half. So I'm going to close the poll now. Let's share those results. 73% of our attendees say yes, too many analytics and don't utilize output. 23% being not sure, we don't run many reports, and 5% saying no, we have a sound process in place. Those are quite skewed, so thanks for sharing those results.
Well, it's exciting to hear that 5% of you say you have sound processes. That gives hope to the rest of us. And if you have a sound process, my encouragement is keep doing what you're doing, because your business is much stronger for it, and you will be able to thrive as we come out of COVID, where others will barely survive. So, and we will certainly explore more of this as we go along, but the more you know about your business and you can delineate according to specific categories and attribute to specific customer behaviors, the better off you're going to be in terms of driving new business or capturing new business. All right, so let's talk about the metrics themselves. The workhorse metrics that exist are contribution margin and gross margin. And as we get into this, a word about semantics. I have worked with clients over the years who define things differently than what I will call standard. They were within GAAP processes. I want to be very clear about that, but who used these terms in ways that were different than the standard definitions. And so for that reason, and for purposes of our discussion, I want to share with you the definitions relative to gross margin and contribution margin. So gross margin takes into account all of the cost to sell the product, both the direct cost, which is manufacturing cost, and then everything to actually sell it, to provide it to the customer. And I took that from the Investopedia. Contribution margin is the product price minus the associated variable costs. So variable costs being those costs that you avoid if you don't manufacture the product at all, meaning the material cost essentially, and the labor to produce that product. So, and you'll see that I defined the variable cost myself because I didn't like what I was finding online to give you some clarity around that. So just remember, variable cost doesn't have any overhead in it or any sales cost in it. Okay, so just a little groundwork there to provide a platform to work from. So if we're going to increase our business, how are we going to use these metrics? Well, we're going to use them to inform our choices. Things like, do I want to offer a contract to my customer at this price? And we're going to use them to guide our decision making in terms of whether it be on a deal by deal basis, whether it be a way that we forecast for our business for the following year, whether it is specific promotional opportunities we want to offer, and what customer segments do we want to offer those to. So some of the most typical questions that I see analytics answering for us are, what's the customer's current gross margin? When was the last time they took a price increase? What's their volume been over the past 3 years? And have they brought us any new business? I think with those 4 pieces of business, you can, or pardon me, 4 pieces of data, you can get a really good idea of what's going on with your customer. So let's look at some pieces of information we would expect to see. We would expect to see in a waterfall report, and I'll show you an example of that on the next slide, but the waterfall has the customer name, what the product is that's being sold, what the margins are, whether it's contribution margin where you're only measuring material cost, or whether it's gross margin and you're measuring the impact of the cost of goods sold, the sales process as well. It'll show if there are any special programs that that customer's participating in. So whether you have rebates, or whether for those of you who were in pricing when there were significant spikes in oil as well as in resin, if you were in the plastic industry, many companies put in resin surcharge programs. It'll show year-over-year comparisons of profitability, and it shows a customer's behavior pattern in terms of what they've bought year over year. It also can indicate manufacturing efficiency. So let me show you what a waterfall can look like. And when you first look at this, you think, wow, awful lot of information going on here. So let's take a few minutes to walk through this, because if I could only pick one report, if I could only see one report, this is the one I will ask for every time, because to me, it can't hide anything. So let's take a look. If there's a parent company, it gets listed. And then if there's a specific sales region, it gets listed. And I've of course changed this data for confidentiality reasons. Sales representative, John Wayne. The sales channel, so where did it come through? So it was standard sales, or it would have been listed as distribution or something separate. And then of course, where geographically did this take place? We see at the very top, it tells us who the customer is. It's a big box store, and it's all their locations concatenated together. So I'm not just seeing one location, I'm seeing all of them. And then this covers from 2011 to 2014. Is it one of my top customers? Yes. And when I look at a report, I want to know that to help make my decision and inform me. Are they on any kind of surcharge? And again, this would be relevant for if you were surcharging for freight, or an upcharge when oil was volatile, or resin if you're in the chemical industry, etc. And that PPA was a specific designation of the kind of surcharge that the customer was on. And then it tells us if there is an additional surcharge for anything else. So really, how often have we gone to price something and we talk to sales and they say, you know, this is a great customer, I need to increase my volume with them. They'll take an extra 100,000 units, but we've got to drop the price 15%. And we try to make that decision. And in the end, okay, it's decided we'll take that business. And we find out later that the customer's already getting free freight or special packaging or some other give on our part that costs us from a profit perspective. So it's really important to know that up front and to see that here. All right, so let's get into the numbers now. If at 2014, you can see that their revenue was down a negative $7,371 because they had actually returned $11,993 worth. It's important that you see the returns as well, again, because otherwise it looks like you had more revenue coming in than what you really did. Now, when we talk about customer behavior and being able to see what the customer's actually doing, compare that to 2013, where the customer did $604,000. Pretty significant drop. And in 2012, they did $148,000. So you see wildly erratic customer buying behavior. So it looks like in 2013, that customer had a very specific need, and then either their business dropped off, and which is why by 14, they really had no business to give us. But it allows you with this kind of information to go and have those discussions. And that's really important. And you can see the impact from those revenue streams in terms of if there was sales commission given, it would be listed here. what the material cost was, what your margin dollars were, and then margin as a percentage. Now for this particular client, they also added in pounds because they were selling pounds of material. And so they measured the price per pound of the material they sold, as well as the contribution dollars of the material. Okay. Are there any questions, Matt, that are popping up yet?
No, not as of yet. It seems like everyone's really following along. But if I could ask another poll based on what everyone just saw, I just want to see, you know, from the attendees, is your analytics output useful? Does it get acted upon? So if that's okay with you, I'd like to launch that poll.
Oh, please do.
I'll give everybody about 30 to 40 seconds to answer that, and we'll share those results and kick it back over to you. Seeing some votes come in. Seems like we're a little heavy on the middle side, somewhat useful and acted upon. Just give everybody a few more seconds to answer that. Awesome. I'm going to close the poll here in just a few seconds. Let's share those results. So 19% say yes, useful and acted upon, 69% saying somewhat useful and acted upon, 13% saying not useful nor acted upon. Interesting results.
You said 13% not useful or acted upon.
Yes, with 69%, the heavy part being in the middle, somewhat useful and acted upon.
Okay, so that's good news. At least that means that in general, we're working towards getting metrics that we can actually do something with, right? So let's look at another kind of report that I think will give you some information. How often in pricing do we get hit with, how do we look against budget? Now, most generally, at least in my experience, that was an ask that came from sales. So sales would come through and say, other than the profitability on the customer, and it was always sales management that was asking this, how am I compared to what our budget says we ought to be achieving? So I wanted to share some specific examples with you so that you could see how this could be done. Again, this particular client was focused, they measured their business in pounds. If you measure your business in volume, you would just translate that to volume. So you would say here that this AB stock item, instead of pounds, was in individual units, for example. So you'd have units here instead of pounds. And instead of price per pound, if you're measuring in margin percentage or contribution margin or gross margin, you'd put that there. And then you've got your sales dollars. And then for this customer, total pounds. What I want you to note about this report is it's global. So it has domestic North America, it has Asia Pacific and Latin America. Again, depends on obviously your company's business, but it's very helpful to have one report that condenses everything globally, and then you have the regions separate so that you've always got a clear picture of what's going on in total. Because certainly what I have found is you can have very strong performance in one or two regions that can buoy your numbers, and you think, wow, we're doing really good this month. And then you find out that whatever it was, for example, if it was in Latin America that was helping you, disappears, and the next month your numbers look deplorable and you can't figure out what's going on. So wanted to share with you here a comparison of a way to put a report together that shows actual versus what the budget says that you're going to achieve, so you know how close you are. And then the different metrics that could be used relative to whether that's price per pound or units, etc. Okay.
Hey, Lydia, I have a quick statement that was shared with us, and I was hoping you can provide some helpful tips based on your experience. So one of our attendees said, reports are useful, but it's hard to get the team to act upon the reported data. So based on your previous experience, do you have some helpful tips to, bridge that gap to get people to actually act upon that data that is being reported?
So I do. The first is, we have to train our executives to see the same thing each time, because they're not going to act if we are not absolutely consistent. So my first tip is, every single time you show a report to an executive who could actually act and do something, make sure the color is the same, your categories are the same, your headings on your columns are the same. The reason I'm saying that is, executives generally, or the people that we are trying to get to go do something, glance at a piece of paper and then they run off to something else. So as long as we don't change anything, we can show them comparisons that can get them to act. So for example, this chart we're looking at right now shows total customer profitability for a business, shows the years 11, 12, and 13. And you can see how contribution margin dropped from 71 to 67. In order to get someone to act, I would do a projected line. So let's say, so pretend this is 2020. So I would show 2020 with the number of customers. And then in this case, because it's the pounds that are being forecasted, I would forecast the pounds that I saw at the new sales revenue. So I'm going to use price as the example to get them to act on. Let's say you want them to raise prices 5%. I'm going to show that 5% price increase as a line item here as a comparison to what they're seeing currently in this contribution margin column. Likewise, I'm going to go back to the previous screen and I would do the same. So you see here what was budgeted. I would put in, instead of this variance column, I'd get rid of that. I would show a projected of what we could look like as an actual if we raise those prices 5% and how that compares against the budget. I think there's nothing more likely to leverage a manager or an executive to act than when they can see a very clear comparison of the before state and the after, and you've projected it. The other thing I would do is, so again, using the 5% price increase example, 100% of your customer base is not going to take that 5% increase. So stop the objections before they even start. The first thing your CFO is going to tell you if you propose this is, well, last time sales only got 50% of the customers to take the price increase. So your numbers are wrong. So beat them to the punch. Use 50% as the number that you project. So in other words, if you project 5% increase, take half of, let's say it's $1 million for all of your customers, right? So just take half of that. Don't assume it's $500,000 that will be impacted, not the million. So hopefully I answered your question. If that wasn't enough, please just pop back in again with questions and we'll continue to answer them.
Thank you, Lydia.
Okay? Sure. All right. So what's an example of a bad idea? If I was to show you a dashboard of something you would not want to use, here's some examples. You know, they look like your printer threw up and then like finance got to edit it. There's colors everywhere, there's graphs everywhere, way too much information. And a colleague of mine, senior executive when I worked for a plastics company, I had put together a dashboard like this. And he looked at it and we had built a very good relationship. And he said to me in very colorful salesman's language, "What the heck is this? And what do you really expect me to do with this?" And I learned a valuable lesson because he was honest with me. Too much information is overload and nobody's going to act on this. And I was lucky that he shared with me that what I had provided was useless to anyone except my own team. So be aware, less is much more. Whatever you're monitoring, you have to do it rigorously if you are going to get upticks in this current environment. If you, now Peter Drucker, so the old iconic founder of current business thought, if you will, basically said, if it gets measured, it will get managed. Meaning what we measure and what we show, we always act upon, and we always track very carefully. So things like top customers profitability, profitability by deals, tracking according to your budget, those always get measured, but be very rigorous. Don't change your processes partway through. Understand who's bringing money into your business. Who are those customers? Where are they located physically? What's important to them? So this gives you a chance to see and view timelines holistically. And I'm picking up the pace just a little bit because I want to make sure and give everybody enough time for questions at the end.
Thank you, Lydia.
Of all the things that I can encourage you all to do, find out who's using your metrics and be sure that there's a real need for them. Stop generating the reports that are taking you time and effort and energy in your departments. Just don't use them anymore. Trust me, if there's somebody senior who's using that report for a reason, you're going to hear about it. And if they come back and say, why'd you stop doing this? It's absolutely legitimate to say, we were spending time and effort that needed to be focused on our customers. We didn't realize it was being utilized. And you want to keep those reports clear and simple, right? A note here about right now is the best time to default to yes with your customers. As you're looking at your metrics, as you're looking at ways to utilize them and leverage them, find ways to work with your customers, because right now that's what they're looking for. If your customers see you as a value-added partner who's willing to work with them regardless of what the metrics say, that is a differentiator, and they will stay with you. It helps develop and solidify relationships outside of just what that profit report says. A caution for all of us. In our reports, no matter what we see, there is always a temptation to drop that price because that's going to fix everything, right? We'll make it up in volume. Too many companies have said, we'll make it up in volume and gone right out of business. And in this post-COVID environment, this statement is all the more critical. Nobody has excess cash flow available. Everyone is trying to survive. So what I am suggesting is, by tracking your metrics carefully, by being there for your customers and helping them make the best decisions possible, you avoid this downward spiral of racing to the bottom and trying to race your competition to get to the bottom. When we talk about metrics and we talk about profitability, be warned, profit margins don't just drop. So in other words, we don't make a poor pricing decision and take on business that's very subpar to what we would normally accept because we're desperate for business and it shows up next month in the numbers. It can take 6 months or more before the full impact of that profit degradation actually shows up. And that's because of volume and of timing. So please be very, very careful about, as you view your margins, don't think that just because the margin looks good this month, that it might not be slipping, which is the reason why you want to look at things like that customer waterfall that tells the whole story, and look at your numbers against budget, which again, help give you that other perspective. So now we're at the point of hitting return on sales. Matt, are there any questions we should address before we jump into return on sales?
None at the moment. So any of the attendees that wish to have any other questions, please feel free to start submitting them for the Q&A before Lydia wraps them up, and then we can answer those, but there currently aren't any at the moment. Okay,
terrific. All right, so return on sales. It's usually referred to as operating profit margin. It's a financial ratio, and its intention is to show a calculation of how efficiently a company is generating a profit from its sales. So in other words, for every dollar that your company generates in revenue, how much of that is going to the company's bottom line or to the profit? And that, I took that from my accounting course. So return on sales is net profit divided by net sales. Okay. And here's some examples. Now, this example here on the right of a return on sales of 25%, anybody that I have ever spoken to in business would be dancing in the streets if they had a return on sales of 25%. A return on sales of 5 to 10% is what most companies aim for. So meaning 5 to 10 cents for every dollar a company generates, which sounds very, very low. But when you think about the amount of not only investment, but the cost of goods sold, the cost of sales, essentially, material cost, by the time you add up all of the different costs of a business, if you're putting 10 cents for every dollar away in profit, a company is doing well. So if you want to grow that return on sales, you have two options. You can either increase your price while keeping your cost constant, or you have to decrease your cost while keeping your price the same, because those are the only two levers you have to work with, are price and cost. So I know I ran through the end fairly quickly, folks, but I wanted to make sure and get that in and save us time to go through some questions. I think we had a question posted, Matt, previously that I want to speak to, that asked if I have 30,000 customers and 30,000 products, do I just look at the top customers and only customer segments and those product groups instead of looking at my SKUs? Absolutely. So for any of you that have really high number of product SKUs and a very high number of customers, my suggestion is you group them in the ABC format, meaning A is your top customers, and generally speaking, that is the top 20%. So find out who, not only through revenue, but also I would look at profit dollars, because that can be confusing or misleading. You can have someone with very high revenue that has very poor margin, and they're not bringing the cash into your business, but someone who has middle range revenue that has very strong margin is actually a key contributor to your business. So you don't want to miss that. So I would use both of those metrics, profit as well as revenue, to determine who those customers are that are bringing the cash in my business. And then I would set the second, that B grouping, that next group down, in a range, and then that final group of kind of your C customers that are the poorest producers of both revenue and margin. So I hope that answers that question. And then in terms of segmentation, so that's your initial start is A, B, and C. You could then go back and look at things like industry to find out, is there a particular industry that is adding more value to you as a company? And how could you then make decisions that would offer something specific to that industry to make it more enticing for them? So for the person that asked that, thank you. Matt, do we have anything else?
Yeah, absolutely. Someone just asked, do you consider those to be marginal customers that contribute to fixed costs?
So no, I don't. I think that they have they are of value, especially in specific situations. That situation being, let's say that you have a great deal of capacity right now in a specific kind of product. If that particular customer happens to buy that product, you have a golden opportunity. They are contributing to your fixed cost. So if you take on that customer at a reduced margin right now because of the circumstances, they are still contributing to your overall. So no, I do not consider them marginal customers at all. I think intentionally leveraging them is what's critical. And if I didn't answer your questions to the person that asked it, please ping us back, and certainly I can give you a fuller answer.
Thank you, Lydia. And another question is, you might have already addressed this, but how to start quantifying the value for each customer and micro segment.
Okay, so when we talk about micro segments, I'm going to assume that what that means is you've segmented your customers really far down the chain. So you did the A, B, and C groups, you know who's most profitable, then you're getting into what industries they are. And so what I would say is, the first place to start is run margin percents on all of them, run the revenues on all of them, and then based on that, so that I'm always going to go back to margin and revenue, whether it's a micro or a macro segment, as my first place to quantify value, because that's where the money is, right? So I want to know who's giving me profit. So those are the two initial criteria I would utilize. And then the other criteria I would utilize is, what things are they getting from me for free? Are they getting free freight? Are they getting rebate programs? Are they getting access to a distribution network? I would ask those questions as well, because I think that that's very important in determining what your net profit is, that net customer value. So I hope I answered that for you.
Great, thank you so much, Lydia. And if any of the attendees have any more questions to ask in the next few minutes, please do so. I just remind you that this presentation is available in a handout that you can download, just if you want to reference back, and a recording of this webinar will be emailed to you after, so feel free to share that along or to come back to it and visit in the future. So if there's no more questions, doesn't seem like it. I just want to thank Lydia for a brilliant presentation. This was really valuable, and the visualization as well as the content you provided was super helpful, and I hope our attendees see that as well. So thank you so much, Lydia. Really appreciate it. Everyone that would like to connect with Lydia, her number and email is on here, as well as she has LinkedIn, and of course feel free to reach out that way as well. So if anyone has any more questions, this would be the time to ask it now. And I just want to say, Lydia, is there any notes that you would like to say before we close this out?
So thanks so much, Matt, for the opportunity, to you and PriceFX. And I just want to encourage everybody, if you are running your metrics, keep doing it. Get rid of the ones that don't support you, that take time, that you feel like nobody's using, and stick with one or two. And from those one or two, you really can drive very significant value. I think that's critical. Just focus on one or two and get rid of the rest, because they just take up your time. So I wish you all the very best of luck. Reach out if I can help you.
Thanks so much, Lydia, and thank you for everyone that participated, receiving some really positive feedback. So like I said, feel free to reach out to Lydia. And if you have any questions in terms of PriceFX, feel free to respond to many of the emails that I sent you in terms of this registration. Otherwise, we look forward to connecting in the future and also having Lydia present again. So thanks again, Lydia, and thanks to everyone for attending. Have a great day, everybody. Stay healthy and stay safe.
Thanks, Matt.
Thank you. Bye-bye, guys.
Bye-bye.